You're listening to TIMESTAND the Theory.
Hi everyone! Today we are going to talk about exchange risk management. Exchange rate volatility is unpredictable since there are so many factors that affect the movement of the exchange rates. Example of economic fundamental: monetary policy, fiscal policy, global economy, speculation, domestic and foreign political issues, market psychology, rumors, and technical factors. The exchange rate volatility poses a risk, called foreign exchange risk or currency risk, to business sector. In particular, the importers and exporters are those ones who associate with international businesses. Although businesses could not control the fluctuation of the exchange rates, but they can manage the risk by using proper hedging tools, e.g. forward, futures, and options, in order to manage their revenues and costs more efficiently. Currency fluctuations are a natural outcome of floating exchange rates, which is the norm for most major economies. Numerous factors influence exchange rates, including a country's economic performance, the outlook for inflation, interest rate differentials, capital flows, and so on. A currency's exchange rate is typically determined by the strength or weakness of the underlying economy. As such, a currency's value can fluctuate from one moment to the next. Many people do not pay attention to exchange rates because rarely do they need to. The typical person's daily life is conducted in their domestic currency. Exchange rates only come into focus for occasional transactions, such as foreign travel, import payments, or overseas remittances. An international traveler might harbor for a strong domestic currency because that would make travel to Europe inexpensive. But the downside is a strong currency can exert significant drag on the economy over the long term, as entire industries are rendered non-competitive and thousands of jobs are lost. While some might prefer a strong currency, a weak currency can result in more economic benefits. The value of the domestic currency in the foreign exchange market is a key consideration for central banks when they set monetary policy. Directly or indirectly, currency levels may play a role in the interest rate you pay on your mortgage, the returns on your investment portfolio, the price of groceries at your local supermarket, and even your job prospects. Currency impact on the economy. A currency's level directly impacts the economy in the following ways: merchandise trade. This refers to a nation's imports and exports. In general, a weaker currency makes imports more expensive, while stimulating exports by making them cheaper for overseas customers to buy. A weak or strong currency can contribute to a nation's trade deficit or trade surplus over time. For example, assume you are a U.S. exporter who sells widgets at $10 each to a buyer in Europe. The exchange rate is €1 equals $1.25. Therefore, the cost to your European buyer is €8 per widget. Now let's say the dollar weakens and the exchange rate is €1 equals $1.35. Your buyer wants to negotiate a better price, and you can afford to give them a break while still clearing at least $10 per widget. Even if you set the new price at €7.50 per widget, which is a 6.25% discount from your buyer's perspective, Your price in dollars is $10.13 at the current exchange rate. A weak US dollar allows your export business to remain competitive in international markets. Conversely, a stronger currency can reduce export competitiveness and make imports cheaper, which can cause the trade deficit to widen further, eventually weakening the currency in a self-adjusting mechanism. But before this happens, export-dependent industries can be damaged by an unduly strong currency. Capital flows. Foreign capital tends to flow into countries that have strong governments, dynamic economies, and stable currencies. A nation needs a relatively stable currency to attract capital from foreign investors. Otherwise, the prospect of exchange rate losses inflicted by currency depreciation may deter overseas investors. There are two types of capital flows. Foreign direct investment, FDI, in which foreign investors take stakes in existing companies or build new facilities in the recipient market, and foreign portfolio investment, in which foreign investors buy, sell, and trade securities in the recipient market. FDI is a critical funding source for growing economies such as China and India. Governments generally prefer FDI to foreign portfolio investments because the latter is hot money that can leave the country quickly when conditions grow tough. This capital flight can be sparked by any negative event, such as a devaluation of the currency. Inflation. A devalued currency can result in imported inflation for countries that are substantial importers. A sudden 20% decline in the domestic currency could result in imports costing 25% more, as a 20% decline means a 25% increase is needed to get back to the original price point. Interest rates. As mentioned earlier, exchange rates are a key consideration for most central banks when setting monetary policy. In September 2012, Bank of Canada Governor Mark Carney said the bank took the persistent strength of the Canadian dollar into account when setting monetary policy. Carney said the Canadian dollar's strength was one reason why his country's monetary policy had been exceptionally accommodative for so long. A strong domestic currency exerts drag on the economy, achieving the same result as a tighter monetary policy, i.e., higher interest rates. In addition, further tightening of monetary policy at a time when the domestic currency is already strong may exacerbate the problem by attracting hot money from foreign investors seeking higher-yielding investments, which would further strengthen the domestic currency. Examples of global impact of currencies. Japanese yen's gyrations from 2008 to mid-2013. The Japanese yen was one of the most volatile currencies between 2008 and 2013. Because of Japan's policy of near-zero bound interest rates, traders favored the yen for carry trades, in which they borrowed yen for next to nothing and invested in higher-yielding overseas assets. But as the global credit crunch intensified in 2008, the yen began appreciating sharply as panicked investors bought the currency in droves to repay yen-denominated loans. As a result, the yen appreciated by more than 25% against the US dollar in the 5 months to January 2009. Then in 2013, Prime Minister Shinzo Abe unveiled monetary stimulus and fiscal stimulus plans, nicknamed Abenomics, that led to a 16% plunge in the yen within the first 5 months of the year. Forward contract. A forward contract is a customized contract between two parties to buy or sell an asset at a specified price on a future date. A forward contract can be used for hedging or speculation, although its non-standardized nature makes it particularly apt for hedging. Example of a forward contract. Consider the following example of a forward contract. Assume that an agricultural producer has 2 million bushels of corn to sell 6 months from now and is concerned about a potential decline in the price of corn. It thus enters into a forward contract with its financial institution to sell 2 million bushels of corn at a price of $4.30 per bushel in 6 months, with settlement on a cash basis. In 6 months, the spot price of corn has 3 possibilities. It is exactly $4.30 per bushel. In this case, no monies are owed by the producer or financial institution to each other and the contract is closed. It is higher than the contract price, say $5 per bushel. The producer owes the institution $1.4 million, or the difference between the current spot price and the contracted rate of $4.30. It is lower than the contract price, say $3.50 per bushel. The financial institution will pay the producer $1.6 million, or the difference between the contracted rate of $4.30 and the current spot price risks of forward contracts. The market for forward contracts is huge since many of the world's biggest corporations use it to hedge currency and interest rate risks. However, since the details of forward contracts are restricted to the buyer and seller, and are not known to the general public, the size of this market is difficult to estimate. The large size and unregulated nature of the forward contracts market mean that it may be susceptible to a cascading series of defaults in the worst-case scenario. While banks and financial corporations mitigate this risk by being very careful in their choice of counterparty, the possibility of large-scale default does exist. Another risk that arises from the non-standard nature of forward contracts is that they are only settled on the settlement date and are not marked to market like futures. What if the forward rate specified in the contract diverges widely from the spot rate at the time of settlement? In this case, the financial institution that originated the forward contract is exposed to a greater degree of risk in the event of default or non-settlement by the client than if the contract were marked to market regularly. Options contract. Options are financial instruments that are based on the value of underlying securities such as stocks. An options contract offers the buyer the opportunity to buy or sell, depending on the type of contract they hold, the chosen underlying asset at a price set out in the contract either within a certain time frame or at the expiration date. The terms of an option contract specify the underlying security, the price at which that security can be transacted, strike price, and the expiration date of the contract. In the case of stocks, a standard contract covers 100 shares, but the share amount may be adjusted for stock splits, special dividends, or mergers. Types of options contract. There are two types of options contract: puts and calls. Both can be purchased to speculate on the direction of the security or hedge exposure. They can also be sold to generate income. In general, Call options can be purchased as a leveraged bet on the appreciation of a stock or index, while put options are purchased to profit from price declines. The buyer of a call option has the right, but not the obligation, to buy the number of shares covered in the contract at the strike price. Put buyers, on the other hand, have the right, but not the obligation, to sell the shares at the strike price specified in the contract. Option sellers, also known as writers, are obligated to transact their side of the trade if a buyer decides to execute a call option to buy the underlying security or execute a put option to sell. The first option is call option contract. In a call option transaction, a position is opened when a contract or contracts are purchased from the seller. In the transaction, the seller is paid a premium to assume the obligation of selling shares at the strike price. If the seller holds the shares to be sold, the position is referred to as a covered call. The second option is put option contract. Buyers of put options are speculating on price declines of the underlying stock or index and own the right to sell the shares at the strike price specified in the contract. If the share price drops below the strike price prior to or at expiration, the buyer can either assign shares to the seller for purchase at the strike price or sell the contract if the shares are not held in the portfolio. Example of an options contract. Company ABC's shares trade at $60, and a call writer is looking to sell calls at $65 with a 1-month expiration. If the share price stays below $65 and the options expire, the call writer keeps the shares and can collect another premium by writing calls again. If, however, the share price appreciates to a price above $65, referred to as being in the money, ITM, the buyer calls the shares from the seller, purchasing them at $65. The call buyer can also sell the options if purchasing the shares is not the desired outcome. If this knowledge benefits you, please subscribe and hit the notification bell for the next knowledge. Thank you and see you in class.